life. Okay, 1 minute to complete you. Okay, so let's continue. Let's continue. Let's continue. So what we're discussing today, it's simply we're discussing. No, we're going to say it's just 1 hour class. We're going to spend today. I actually have some other things to do. So 1 hour. So by 10 o'clock, we should run off this class. Okay. But if you guys understand this clearly, then I don't think we're going to stay up to 1 hour. Clearly, or less than 1 hour, but we're not going to exceed 1 hour, that's for sure. So what I'm talking about is we're talking about moving average. We'll talk about moving average. Remember, we have discussed support and resistance, which is the bedrock of this of forex. Now we are discussing about support and resistance. We said that place where you have support, you which tells you where to buy or where to sell. That's one, where you should buy, where you should sell. And second, you're not hearing me, just give me feedback. Let me know that you're not hearing me instead of talking and talking. And nobody is understanding, nobody was hearing me. So at that point where you have a supporter resistance, tells you where you are expected to buy or where you expect is. Once you get to that supporter resistance, the next question you're going to ask yourself, what would show me, what would tell me that I need to buy at this point? What should tell me I need to sell at this point? These are the questions that should be in your head. What should tell me I need to buy? What should tell me I need to sell? Now we delve into candlesticks. And we say, okay, candlestick is going to give us lead. Will give us a lead, will give us a heads up on what to do. That's what we discuss. And the candlestick, we spent about, I think, 2 classes or so discussing candlestick pattern. We've talked about different candlestick pattern. We've talked about the hanging man. We've talked about the hammer. We've talked about the single candlestick pattern. We've talked about the double candlestick pattern and the multiple candlestick pattern. Person telling me his network is not allowing. I actually do not know what to do. If it's network issue, try to fix the network issue. Go fast. Okay, so we've talked about the single candlestick pattern. We've talked about double candlestick pattern. We've talked about multiple candlestick pattern. These are candlestick patterns you see at the support, what we call the support and the resistance. And at that point, now we take a decision on what to do, either to buy or to sell. When you see these candlestick patterns appear on, we said, remember I told you that you can see this candlestick pattern anywhere on your chart, but anywhere on your chart does not give you the desired results. Anywhere on your chart does not give you the desired results. If you see it on any place that is not on your levels, on your support and resistance, what it just told you is that that market has just done a pause. a pause, that the market was riding on or moving on high speed. The market, when you see those candlesticks, that tells you a reversal. It's actually not a reversal, but a pause in the market to continue the market, the trend. Because we know price does not move on a straight line. It will move, it will go back and continue the movement. So, but when you see it at a very strategic point, at an area of value, then it tells you that, okay, I have high probability of buying or selling at this point. Without wasting time, we see the market starts going in the desired direction. So that's what we've learned. So now want to learn about another strategy that we can actually adopt in the market or in our trading strategy to ensure that we have a good trade. Now, it is what is called the moving average. Moving average. Moving average. That is what we call the moving average. That's what we call the moving average. Now, moving average, I tell people, it serves as dynamic support and resistance. Please listen. Moving average is dynamic support and resistance. That is what moving average is all about. Sorry. I said moving average serves as dynamic support and resistance. So that when you see the moving average, when you see moving price coming to moving average, it tells you what you need to do, because with the knowledge of support and resistance and candlestick, believe you me, you can actually trade profitably. But we are now giving you another strategy you can engage the market. Now, when you see these things play out, based on your knowledge of candlestick, because the most important thing, the bedrock in this business is support and resistance and your candlestick. These are the things you need. That's what they call pure price action. Now, what we want to tell you now, what we're learning today now is called indicator. Indicator. And the indicators, most of the indicators, 95% of indicators are lagging indicators. When we say lagging indicators, we mean that the act after price has done what it wants to do. Sorry. The act after price has done what they want to do. So that's why it is called the lagging indicator. Lagging. Lagging is that it's coming behind. That's the meaning. It's coming behind. That is lagging. Lagging indicator. That is what moving average is. Moving average. Sorry. Oh, moving average is a lagging indicator. But if you understand support and resistance and you understand candlestick, even before the moving average will give you a direction, you have gotten your direction. You have gotten your direction. Moving average will just come to give you a confirmation of that direction. A confirmation of that direction. So that once it has gotten to your strategy using the moving average, now you sit down in that market and relax. I'll be telling you, I'll be giving you secret on how to use the moving averages. I'll tell you moving averages you'll use so that you back test it and come up with a strategy. See, there's no holy grail in Forex. Nobody has it all. Nobody knows it all. But the truth of the matter is that everybody have their strategy in engaging the market. What we are just teaching you is different strategies. It's for you not to sit down and say, okay, I think I like this strategy. I want to trade using this strategy. That is what you will see. See, I want to trade using this strategy. I want to trade using that strategy. So we'll teach you all of these strategies. Then you make your choice. And that means you need to sit down and monitor the chart very well for you to actually say, okay, I'm comfortable trading using this strategy. And when you have adopted your own strategy, don't ever look at any other thing that somebody is doing. As long as that strategy is giving you what you want, your desired result, brother, forget every other strategy that somebody is using, so that you don't continue to do what is called running around to all strategies, moving from one strategy to the other. No, just sit down. We'll be teaching you so many of them. At least you have like 5 or 6 in this intermediate to learn on engaging the market. But of all of it, don't forget your support and resistance, or your levels, or your psychological round number, or what is called support and resistance, psychological round number, and all of that. We've taught you trend line also. If I've not forgotten, I've not forgotten. Isn't it have done that? Oh, I don't know what, you know. Okay, so now what we're saying now is that I want to teach you, we're teaching you how to engage the moving averages. Now I want to tell you, moving averages, we have 4 types of moving averages. Let me get the slide, please. We have 4 types of moving averages. Okay, there are 4 types of moving averages. We have the simple moving average, we have the exponential moving average, and we have, okay, I'm not sharing that. Let me share. We have the moving averages. Wow. Hi. I just missed so much. Trade. Okay, so moving averages, we said we have types of moving averages. We have simple moving average, we have exponential moving average, we have smoothing moving average, we have linear weighted moving average. These are the 4 moving averages we have. But the one that is commonly used by traders is the simple moving average and exponential moving average. The simple moving average and exponential moving average. These are the 2 moving averages that are mostly used by traders. 98% of traders use a simple moving average and exponential moving average. What it means is that simple moving average is simply the normal. If I ask you what is the average of what's the average, what you just need to do is you get 5 plus 3, you add it together and divide it by 2. The normal simple interest, simple average we're talking about learning school. You have you'll say 5 plus 3, which is 8 divided by 2, since they are just 2, and you have 4. Say 4 is the average of 5 and 3. So they say that's what the price does. That's what the system does for you. Use the simple moving average and have the exponential moving average. What it does is that exponential moving average add weight to the current price moving average does. Now, when we talk about the moving average, price moves. This price we are seeing here, it moves. Price moves. If you see, this is today is what? Today is 24th of March. You see 24th of March, you see the price will continue. The price will continue. If you look at this price, okay, where I am now is the 3rd of March. If you scroll down, you will still see that this price has been moving, let's say from January of this year, January 1st to March 24th, price has been moving. Each day, price will continue to move. So it is because the price is moving. That is why we have, they say, let's get the average of this price that is moving, the average price, the average price. So that means if I say move, if I talk about moving average, I'm talking about the average of particular of price within a particular period. Within a particular period. When we say period, we mean when you say period, it could mean within the, let's say today that is 24th. What is the average price that the market did today? What is the average price that the market did today? That is what moving average will tell you. When you say moving average for like 1 hour, it means that for 1 hour, what is the average that price have done? If you say for 4 hours, what is the average that price has done within 4 hours? When you say one day, what is the average of what price has done for a full day? When you say 1 week, you begin to ask, what is the average that price have done within a week? Within a week. When you say 1 month, it means that what is the average that price have done within a month? That is what it means. So when we say the price has periods, it has periods, period. When we say period, we mean within a particular period, within a particular time frame, within a particular time frame. So if I say, for example, I say 10 moving average, 10 exponential moving average, 10 exponential moving average. It means that wherever time frame that you are, if you plot a moving average and say, I want 10 period moving average on my chart, what you are telling the system is that what has price done within the 10 candlesticks that have passed, within the 10 candlesticks that have price, what is the average of price within the 10 candlesticks? So 10 candlesticks could be 1 minute, which is 10 minutes, 5 minutes, which is 50 minutes, 1 hour, which is 10 hours, 4 hours, which is 40 hours, 1 day, which is 24 hours. Okay, sorry, 1 day. Okay, 1 day, that's 20 candlesticks or 10 candlesticks. Okay, for a day, it means for the past 20 days, what has price been doing? What is the average that price have done within the past 20 days? If you are plotting it on a daily time frame, if you're plotting it on a H4 time frame, you're telling the system, please calculate the average of price within the past 4 hours times 10. That is within the past 40 hours. What has price been doing? That is what you are telling the system. So what the system will do is that it will calculate, it will count the based on the current candlestick. After that current candlestick that is forming as at when you're plotting your chart, it will count from the one after the current candlestick and count 10 candlestick back and give you the average of price, what price has done within the last 10 candlestick. And you know the price is moving. If this price is moving, the moving average will be following the price. As it's moving, the moving average will be following the price. As it's moving, the moving average will be following the price. We'll plot all of this on our chart so that you see how this is reacts to the chart. Okay, now, so I want to tell you, if you are a day trader, if you are, okay, let's start from the scalper. If you are a scalper, that means you don't stay long in the market. You just want to take some pips and run away from the market. The moving average that you use will be quite different from somebody that is a day trader. Somebody that is a day trader, his moving average is quite different from somebody that is a swing trader. And somebody that is a swing trader, the moving average is different from somebody that is a position trader. You must have this at the back of your mind. You must have this so that you understand what we are talking about. Now, look at the moving average. Moving average, I don't want to do all of now, look at it. This is the moving average. I said moving average serves as dynamic support and resistance. Look at it here. If you look at this chart here, look at this chart here. If you look at this chart very well, you see that this chart, price, at this point, price were on top of the moving average. On top of the moving average. If price is hovering on top of the moving average, it simply tells you that that market is an uptrending market, that that market is a bullish market, that you should be looking for buy that market, that the market is an uptrending market, that you should be looking for opportunity to buy that market. But if the price is below the moving average, if it is below, like moving average covering is covering it, it means that price, the market is bearish. So you, as a trader, should be looking for only selling opportunities. Only selling opportunities. That is what you are looking for. Only selling opportunities. You don't need to buy. Look at it here. This price, the market move from here. If you can see my mouse. Hope you can see my. If you can see my mouse, please give me type 1 on the chart box. If you can see my price, type 1 on the chart box. Let me know that I don't want. If you can hear me and you see my mouse, please type 1 on the chat box. So this class no stuff. Have you guys gone to sleep? If you can hear me, type 1 on the chat box. You guys see that can hear me? Okay, please, struggling to hear though, are you sure? Trying to be able to very well. I don't know if it's a network or not. Trying to be able to so now I said, okay, it's only network is not helping. Okay, same here. Chat not clear, not also clear. Wow. Two persons say they can hear me clearly. I don't know if you guys can hear me clearly. That's the issue. Let me know if it's the network of Mr. Isaac and Mr. David. Chat not clear. It's still the network. It will come up clear. Me too couldn't hear clearly. Wow. But can you hear me now? Was you can't hear me clearly? Was it before or now?
We can hear you now, but initially it wasn't. It was just breaking, and I can hear you clearly now.
Okay, please. At any point when you can hear me clearly, just unmute your mic and let me know, please. Because if you don't let me know, I just assumed everybody is hearing me. All right, so let's continue. With the network, let's just manage and see the best we can do. Okay, so now I said if price, what you need to take home today is that if price is moving on the moving average, if price is on top of the moving average, it tells us that the market is bullish. You need to look for opportunity to buy. And where should you buy the market? Look at this point here. Look at the MA. MA is this thin line that is following the price. When you see price come to touch this MA, it is an opportunity for you to buy. If price comes to touch the MA, the moving average, that's what I mean by MA. If price touches the moving average, it's an opportunity for you to buy. It has given you an opportunity to buy. Don't buy when price has gone far from the MA. No, wait for price to come to the MA, then you buy. And when you buy, you use the previous low that the candlestick, that the price made as your stop loss. Previous low that the price made as your stop loss. Or if the price break below this moving average and came back to close above, like creating a hammer and close above, that hammer is what you use. The wick of that hammer is what you use as your stop loss. Engage the market for a buy. When the market touches the MA, At any point when it touches the ME, it is giving you an opportunity to buy. An opportunity to buy whenever price touches the ME. Now, look at when you look at this chart, now you see the arrow, it means buy. You see another arrow here as an opportunity for you to buy. You see another arrow here is an opportunity for you to buy. When we go to the chart to see how this things play out. Now, look at this price. The moving average is covering the price. The moving average is covering the price. As the moving average is covering the price, what does it tell us? It tells us opportunity to sell. Opportunity to sell. Opportunity to sell. Where you have this arrow, it's telling you this is an opportunity where you need to sell when price touches the moving average. If it touches the moving average, if you want to trade moving average, if moving average is your strategy, you will always wait for price to touch this moving average before you engage your sell. Why? Why should you wait for price to touch the moving average? So that your stop loss will not be huge. Stop loss will not be much. You just engage the market. That's a huge stop loss. But if the moving average, if the price is far from the moving average, if you engage your sell or your buy, you are exposing too much of your accounts. Okay, so let's continue. Okay, so now we have, I've just talked the moving average using one candle. I told you if price is above that moving average, it tells you that the price is bullish. You should be looking for opportunity to buy. And you buy when price has returned to the moving average. That's the opportunity for you to buy. If price is covering, if moving average is covering the price, it tells you it's an opportunity for you to sell. Opportunity for you to sell. When you sell, where you need to sell is when price comes back to the moving average and did not break above. Then you can engage your buy or your sell. Okay, so now we have another one they call moving average crossover. Moving average crossover. That is another strategy also, moving average crossover. What it means is that when you have a smaller period moving average, why we say a smaller period and bigger period or higher period is that smaller period move faster and follows the price, move faster. The moving average, when we say moving average 10, period 10 means it calculates only 10 candlesticks and give you the answer, the average on your plot, the average on your charts. Now, when you say 20 period moving average, it means that it will calculate 20 candlesticks and give you the average. So now you agree with me that it will be easy for price to calculate 10 candlesticks and give you the price than it will be for 20 candlesticks, than it will be for 50 candlesticks, than it will be for 100 candlesticks, than it will be for 200 candlesticks. Just want to believe everybody understood this. So when we say a smaller period moving average, it means a period that is smaller when compared with, like if you have two moving average, the one that is smaller is the one that is smaller in a number. Like if you have 10 and 5, 5 is smaller. If you have 5 and 2, 2 is smaller. If you have 10 and 20, 10 is smaller. If you have 50 and 20, 20 is smaller. If you have 150, 50 is smaller. So when you have a smaller period moving average and a bigger period, a higher period moving average, what it means is that the smaller period moving average will move faster to follow the price than the bigger moving average. What it means is that if I have 10 and 20 period moving average and the market is buying, what the price moving average will do is that the moving average 10 will move faster than the moving average 20. So that means if the market is buying, the 10 will cross the 20 period moving average. Why? Because it will take him faster. It will take him faster time to calculate 10 period moving average than it will be for the one that is calculating 20 period moving average. So it will just calculate 10 and move fast. So if the market is going up, that 10 period moving average will be going up. Then the smaller one, the bigger one will be following it behind. And that is why we say the 10 period moving average is faster than the smaller slow moving average. And the slow moving average is the one that is higher. That is what it means. So what do we achieve using moving average? A moving average crossover helps us to answer three questions. Which direction might the market be trending, if at all? If it's a trending market, which direction will it be trending? So the direction that the smaller period moving average is heading to is the direction of the market. If it crosses it from above, from below, and crosses it above, because market is buying, it tells you that the market has a buy momentum. The second one is where might be a potential entry point for a trend trade. To engage your trade, where is the entry point? When might a trend be ended or reversing? Moving average will tell you. So that's what we achieve using moving average. We say moving average serves as some dynamic support and resistance. We use moving average to know where to enter the market and where to exit. We use moving average for our stop loss and our take profit. Okay, so we're gradually coming to the chart. Now look at chart representatives of moving average. Look at it. When you see this, if you see the moving average crossover, look at it here. Moving average, if you see, look like this analysis here. If you see 10, the blue line is 10 SMA. Then the small line is 20 SMA. That's a simple moving average. Now, when you see this, once you see the 20, look at it. The 20 is on, sorry, the 10 is on top of the 20. As long as the 10 have not gone below 20, it tells you that that market, you should be looking for opportunity to buy. And when we should do buy? When price has come back to the moving average. That is where you have opportunity. That's where you have opportunity for a buy. If you look at it here, look at this arrow. It shows that this is an uptrending market. Now look at this. This is a bearish market, a downtrending market. It says, notice how after crossover, the pair began a nice downtrend. Look at this point. Look at the blue line. It has crossed where you have this highlighted point. At this point that is highlighted, you see the 10 moving average crossed the 20 period moving average from above. And as it crossed it down, look at the market started selling. If you are trading using moving average, where this market cross is your entry for a sell. Some persons will say, oh, no, I don't want to enter the cross, no problem. Once this thing has crossed, what you need to do now is that the market has sold, so wait for price to come back to the moving average. Not when you see the market selling, yes, hey, market has started selling, let me go and sell. No, you will always wait for price to come back to you. You will say in this market, patience is a virtue. Patience is a virtue. You must be patient. If you're not patient, this market will teach you patience. That it will teach you, you will learn how to be patient in your everyday life. This market will teach you how, because by the time you start losing money, you understand why you need to be patient. So once the market did not give you your strategy, that is one secret that will help you in this market. Once you have a strategy and the market did not give you the strategy, my brother, leave it. Leave it. Don't touch it. Leave the market. Go and look for another pair that will give you that strategy at any point in time. So what you also understand is that there is always opportunity in this market. If you miss one, leave it. There are multiple opportunities in this market. Have this at the back of your mind. Write it down somewhere that there are opportunities, not opportunity, opportunities in this market. If you miss one, don't let it bother you. Tomorrow is another day. Even that same day is another day. There are so many pairs. If this is your trading strategy, just go to your chart, go to your, if you're using a phone, just put that strategy. If you're using a laptop, save it as a template. As you go to anyone, just click on it. You will see that if that market plays to the gallery, you will be very comfortable to increase, to trade that market. Whatever people is everybody, somebody is telling you, even me that is teaching you today is telling you, you will say no. That person that is giving you signal in your social media platform, once you plot your chart and it did not give you that your strategy, forget it. Leave that trade, leave that movement, leave that signal. Trade your own signal. Create your own signal. That's what we're doing in UTB Trading Academy. We teach you to get your own signal. Don't depend on people's signal, because people's signal will always deplete your account. I've said it often and on. That's why when people say, Josh, give me signal, I begin to ask, if I give you signal, do you trade like me? Do you know how I trade? You have a $50 account, you have a $100 account. Do you know how much account I have? I can see a signal. For me, is a signal. For you, it will not be a signal, because it is not according to your strategy. That is one thing I need you to understand in this market. Okay, I might go to H4 and see a signal, and I say sell. From what I have seen in H4, I know that it means that in that H4, after I've done my analysis, I should just close my laptop and leave 4 hours to move. After 4 hours, I should come back to my laptop. You that is trading 30 minutes and 10 minutes and 5 minutes, can you stay 4 hours? 4 hours, that market might, for 1 hour or 2 hours, that market might be giving me a drawdown. I will see minus in my account, but I will not worry. After that 4 hours, you see the market will just clean up all the 4 hours, all the minus, and start giving me profit. Then you have exited that market with a loss. It could be that you've just seen $2, you run away. Hey, Jesus. You see how the strategy Oga just gave me did not work. Who told you? Meanwhile, you've run away. I am still in that market. At the end of the day, I will make profits. You will not make profits. So why would you depend on my signal? That's the question. That's a question I keep asking him. That man that is giving you signal, you don't know how he trades. He might trade 5 minutes time frame. He has also seen one sharp thing, 5 minutes time frame. He has equity. He has serious equity. He will knock the market with one standard lot, and the market will just move only 10 pips or 5 pips. He will move out of the market and boost his profit on your WhatsApp and say, hey, market is moving. Only 20 pips, you're seeing over $5,000. You begin to see, are you serious? You, in that 5 minutes, 5 pips or 10 pips, you are seeing $1. That man has collected his money. You're seeing $1. Instead of you to close out your $1, you wait, the market will come back and take that $1. At the end of the day, you say, have you blew my account? Why? Because you don't have the knowledge. That's why we're teaching you today, that understand these things we're teaching you. Create your own strategy. Sit down and watch the chart. Do more of watching the chart and see how these things play out. Analyze the chart, predict the chart, talk to the chart, listen to the chart. When you see it, the chart will speak to you. Once you see those kind of things, now you have built your emotions, you've built your psychology in the market. By the time the market plays out again in your life account, with that conviction, you will enter with a good lot size and come out with something. Okay, that being said, let's go. I think these most things we'll talk about in advanced class, but that's, I don't know, I keep saying it because my passion for people to succeed is always burning in me, and that's why I don't wait till advanced class to say all of these things. Okay, so that is it. When you see this moving average crossover, once the market have broken, you have confirmed that, okay, the 10-period moving average has crossed the 20-period moving average. Now you now tell yourself, now my bias has changed from a buy. I need to look for opportunity to sell. Now, as you wait until this price will come back to this point, when you see this price at this point, now this is where you start looking for candlestick pattern. You might now be looking for a shooting star, or a gravestone doji, or a harami, or an engulfing, or tweezer, or what's it called, or dark cloud cover, or piercing line. Sorry, dark cloud cover, the resistance you want to sell. Or you talk about the sandwich, or you talk about morning star, sorry, evening star at the resistance, or you talk about abandoned baby, perish abandoned baby. Anything you see here that we have taught you on candlestick pattern, you can get your slide and go back to that candlestick pattern and see what we're talking about so that you understand it and internalize it. Now you get this, enter here for a sell. By the time you enter here for a sell, look at it. You will just put your stop loss above this high here. This high here becomes your stop loss. This high becomes your stop loss. What I'm saying is that when you have done this, okay, let me see. This, if you enter here, like you enter at this point here, you will take here as your stop loss. Take here as your stop loss. Once you put your stop loss at this point, you will see that that is when you will be trading without stressing yourself. You can just place your trade and go to your shop. You can place your trade and do whatever you want to do in your office. You can place your trade and do anything. If you put your stop loss here, the market comes and take your stop loss, no problem. It means that the market has changed direction from what you used to know. But if it does not take your stop loss, brother, you will remain in this market and continue to suck the milk of the market. Imagine somebody that enter for a sale, and look at it here. You would have taken all of these things and enjoyed. What you're looking for is, I am looking for, this man that entered now will not mute his mic. Have you people seen trouble? Later, this same Isaac will come and tell me that he cannot hear me. Or he will tell me that he did not understand when I was talking candlestick or talking when he crossed from below to above. That is the same person that will tell me that. Isaac, mute your mic and discuss whatever you want to discuss in your house.
We have two Isaac. It's not my own Isaac.
Okay, off your own. Okay. I was talking about Isaac or Sir or so. Okay, so let's continue. So once you
okay,
see this,
I think I just joined right now. Sorry. I had network issues, so.
Mute now. Mute. Mute, okay. Okay, so once you have seen this thing, it crossed below, leave it. The market crossed with this candlestick. Leave it, don't worry. Wait for it to come back. Anytime it comes back, once it has come back, what you're looking at now is candlestick pattern. By the time you see any of those are reversal candlestick pattern, brother, engage that market for a sell. Once you see it, engage it for a sell. Put your stop loss above this high. This high. Market did not come close. And you know what? You're not leaving your stop loss here. By the time this market moves like this, come back again and did not break above, start going down. This is an opportunity for you to enter the second one, to take this one. That means you have two trades now running. Take your stop loss, lock it here. You have locked this trade. Even Satan knows that even if your laptop fall inside the river, that money is in your account. Nothing will happen to that money. It has been locked. It has been aimed. You know, in economics, that's what they call income aimed, not collected. You have aimed that income, that money is there. So it is your money. This second one that is moving to is another money. Once it comes here at this point, it did not break below. Enter again for a sale, the third one. If you have the strength, if you don't have, leave it. These two will be running. Take your stop loss and lock it somewhere around here. See this market. Where you want to run away is now that it has broken above. Brother, where this thing break above, look at where you enter for a sale, somewhere around here. This price here. Now, price came here and start break above here. Brother, from here to here, you have collected enough money for the market. You can exit the market. What you are just looking at is that as price broken above my moving average. If it has not broken above your moving average, you don't have any business in that market. Leave the market to be enjoying itself, sucking the breasts, the milk of the forex. So, all right, let's go straight to our chart so that I said this class is going to last for just 1 hour. By 10 o'clock, we're going to class close. That's why it's actually not just something serious. So now I want to tell you before we start plotting the chart. If you are,
Okay, I said that we now want to go to the chart and see what we can do with the chart. Make sure my screen. Okay, now this is the chart. Now let's see. Now I told you if you are a scalper, I was saying if you are a scalper, you should look for a scalper uses 5 and 10 period moving average. If you want to use 2 moving averages, 5 and 10. Once 5 crosses above 10, it's a bias for a buy. If it crosses above 10, it's a signal for a buy. If it crosses below 10, it's a signal for a sell. But in FX space, we don't actually encourage you to be a scalper. No. The best you can be is a day trader. Scalper does not, you stress yourself and you may not get the money. We encourage you not to be a scalper, but to be a day trader and at least a day trader. Now, for a day trader, you need 20 period moving average. You need 10 and 20 period moving average. 10 and 20 period moving average. 10 and 20 period moving average. For a swing trader, you need 20 and 50 period moving average. 20 and 50 period moving average. And for a position trader, you need 50 and 200 period moving average. 50 and 200 period moving average. Well, this thing is not cast on stone. It's based on experience and usage. Based on experience and usage. So that's why we told in FS space, we don't teach you the book, we teach you where you reach, you actually need to know based on our years of experience. So some persons could just choose 800 period moving. I have a colleague that trades 800 period moving average. So him is a strategy and it's working for him. Yes, it's working for him. So you can decide to, let me plot 1,000 moving average and see what happens. It's your choice. Let me plot 50 period, 60 period, 70 period, 80 period moving average and see. So the most important thing is just get a concept and see how these things work. Then backtest it in your own so as to create a strategy for yourself. That's what I'm saying. Okay, now, with, this 9:49, we need to be fast. Now, I want to put the 10 and the 20 and 50 period moving average. This is the moving average. This rope you see here. I'll do it, change it. Now, if you want to get it, let me remove it so that I don't get some people confused. Now, look at this moving average. This is Brent. This is Brent cash. This is Brent cash. This is this oil. When you're hearing that the oil money in Forex is things like this, if you catch it, that's why I was very angry. I placed a sell here when I left the office today. I placed a sell here. I came back home and saw that I saw something and I felt like, oh, it's getting night, it's getting late. Let me go so that I sleep. I don't want to be looking at chat. I said, okay, let me go look out of the market. Immediately before the class, we look at the drop. Only this drop alone, even if you use a 0.01 account and you get this thing would have given you over $20 or $30. This move, only this one would have given you over $20 or $30 profit. But if you don't have equity, if you meet it at the wrong side, sorry is your name. You don't encourage people that does not have. If you have like $500 and above, then you can trade it. But if you have the mind, if you have $100, you can trade it. But when you understand how you got the strategy on how to trade this market, you can actually trade it with the $50. But please, it is not a financial advice I've given. It's not, for me, it's not right because you're exposing your account to depletion, and I don't like you depleting your account. Very bad. Okay, so now let me plot the 10 and 20 on this chart. How you plot the chart, you draw your descent is go to, you'll see this point. Okay, now look at it. This is, you come to this your indicator. You come to this indicator list. You click on it. You see, if you have not clicked on it before, you just come to trend. You see moving average and trend. You come to trend. Trend, look at trend. This is trend. Go and look for moving average. Moving average is the moving average is a trend indicator. Trend, that's why you see it on trend. It's a trend indicator, trend following indicator. It is placed on the chart. All of this sees you as average directional movement index, Bollinger Band, envelopes, Ichimoku King, Ohio, parabolic standard deviation, moving average. They are all trend indicators. You find them on the body of your chart. That's why it's called trend. Then when we go be talking about RSI, MACD, and all of that, you see it as oscillator, but we'll come to that. So now go to moving average, click on moving average. I want to put moving average 20. I want to put exponential, then apply to close. Style is black. The levels, leave the levels. Visualization, leave it. You're just concentrating on parameters. You click OK. This is 20 period moving average, 20 period moving average. And we say at any point, if you're using this 1 period moving average, at any point, price is below the moving average. It tells you look for opportunity to buy. Look for opportunity to buy. That is what it means. Look for opportunity to buy. Once it is below, look at it now. The price is now, look at the current price. I told you we don't do this with current price. When price is below, now I'll be expecting this price. Okay, this market will close by 10. I'll be expecting this price, it will close by 10 and open by 1 o'clock. That is when Brent opens by 1 a.m. I'm expecting this price. I'll be very comfortable to wait for this price to come to this point. If this price comes to this point, which is my ME, by that time this ME would have come down, then I will engage my sell. I will not go and sell here, because if I sell here, where will I put my stop loss? That's the question. My stop loss, if I sell somewhere around here, let's say somewhere around here. If I sell somewhere around here, my stop loss ordinarily should be a little above this. That's my stop loss. That's my stop loss. It's like that. That's what I should use as my stop loss. If I buy here, because the market is above, if I buy somewhere here, I should use somewhere here as my stop loss, as my stop loss. You see, price did not come close to it. Even if price should come and take it, no problem. But if price does not take it, my brother, you will be a massive profit. Massive. Now, if I have bought this, the market has gone right. The market came back to this place. I'm now waiting for this market to break below. This one that is, this red bearish candlestick would have scared me away for me to run, that the market has broken below. But look at the next candlestick. So I told you, if it breaks below, leave it. You are waiting for it to go back. If it goes back and it won't break, it continue up, then it tells you it's an opportunity for you to run and leave the market. You leave the market for good. When this market break here, you see that even if you enter this market here for a buy, you will still be in profit. Now, at this point, look at this one, break here. Look at this one, went back. Listen, went back, did not continue above. It should tell you, guy, it is time for you to exit the market. It is time for you to exit the market. If you did not exit, look at the market came back, it's depleting your profits. So now it's telling you time to get out of the market. You understand? Somebody say, you get it? Get out of the market. That is what it's telling us. Get out of the market. If you get out of the market with your profit, good. But if you don't, because you say the market will always speak to you. Once the market speaks to you, you do what? You listen. If you don't listen, the market will deplete your account. This market came here. Look at this market broke below. This one came here as a hanging man. And it's a hanging man. When you see this thing, look at the next move down with a momentum. The market came back and tested it again. Even if you're stubborn here, look at this. The market came down. Remember, if you had left here, you would have made these pips. Let me show you. If you had left the market here, you would have made these pips. This about, okay. You would have made this about 3 pips. And 3 pips in oil, in crude. Over here. 3 pips in oil is not contract, it's not beans. If you calculate how much it is here, let me show you. This what it means. This is 117 per barrel, and this one is $116 per barrel. That means you have lost $10. 116, okay, 117, 100, 107. Wait, let me see. Okay, this is 117, 46. 46, this is 116. So you've lose almost $1, $1 and some cents. You've missed, and it wouldn't be nice. You would have left when the price is high, leave the market, then the market continues with it. Oh, this is $1. That means $1 times 116. That's what the PIP for bread cash. That's cool. This is cool. It's not ordinary currency. It's cool. If you try it, don't try it if you don't have enough credit. It's not good. It's fine. Okay, so this moving average. Now let me plot another moving average again, in case we have once a crossover. Now I want to put a 50 period moving average. I want to put a 50 period. Oh, this is it. I'll go to moving average. I'll come exponential. I want to put 50. 50. What I just need is to change the color so that the two will not be the same. I'll change the color to dark blue. I'll click OK. This dark blue is almost simple. Making the color to okay. Now look at it. Look at this point. Look at where the 20 period cross 50 period. Look at it here. 20 period has crossed 50 period. When it crossed 50 periods, at this point, when you cross 50 period, at this point, when you cross 50 period, look at this point when you cross 50 period. This place I just circled now. At this point, when you cross 50 period, now your bias now is I want to buy. I want to look for opportunity to buy. Price came here. Let's say you miss all of this, for example. Now price, you're waiting for price to come down so that you buy low, because if you come and buy here, you're buying high. You come here, wait for price to come to either of these moving average, 20 or 50. As it did not break below, brother, you will engage your buy. Look at the buy. Look at the buy, massive buy. Look at this. It came back again to this point. Imagine if you had entered here for a buy. Look at it. Let's say you entered here for a buy. Entered here for a buy. Now the market came here. Look at the market came here at this point. It did not break above. You are looking at it. It did not break above. So many persons will say, nah, this thing, let me just collect my. When it's happening like this, at least fear will grip you. Some persons, when it comes at this point, will take the profit. But when you have your support and resistance, once it has gotten to a resistance, you know that this market have potential to sell. You would have taken your profit up here. Instead of this thing, you deplete your profit very well. You would have taken your massive profit here. But this thing now has given opportunity for others to enter the market for a sell. Sorry, for a buy. The market entered for a buy. Look at the market, went up again, and the market continued up until now that the market have broken below. If you are using moving average crossover, you wait until this 20 period moving average has crossed 50 period moving average. It tells you that now we are in for a sell, and the sell has set. The sell has set very well. That's why I told you this is a lagging indicator. If it were price action, you would have seen that what Ezinne taught you yesterday when I had issue on Tuesday when I had issue by a laptop, is that this thing here, what we have here is called what? Somebody should unmute and tell me what this is. Which candlestick pattern is this? Which candlestick pattern is this? Tell me fast. Somebody should unmute and tell me this is another candlestick pattern. Somebody should tell me. I need somebody to tell me this is another candlestick pattern. Isn't it taught you yesterday? Somebody should mute and tell me. Unmute. This one first. Then you tell me what this one is. Tell me this. Start. No time. Which one? Is it this?
Yes, sir.
Is what?
Okay.
It's not sandwich. I heard you when you say sandwich. It's not sandwich. This thing is called Evening Star. This is called Evening Star. This is called Evening Star. Evening Star. That's what it is. Evening Star. This one is called Engulfing. Engulfing. This one is called Abandoned Baby. This one I highlighted here is called Abandoned Baby. The market has given you 3 signals for a sell. You have engaged yourself. actually in this Brent, I sold this Brent. Up to this point, I took my profit and I was expecting this market to continue to sell. But this push up made me leave the market because Brent is very volatile. I don't want it to come back. My bias was that it was coming to create another high here. So I left it. So this market dropped down. I still have opportunity. As I told you, if you miss opportunity, don't worry. Tomorrow is another day. I still look for opportunity for the sell of this market. So until then, we'll be looking for opportunity to sell. Okay. So this is the moving average we're talking about. This moving average, moving average. You see, look at it now. Look at it. Look at where price moved. Price crossed 20 period moving average, cross 50 period moving average at this point. And after that, look at what happened. Market started selling massively until when price break above this. If you see, price never break above even the 50 period moving average after this sell, this cross here. Let's say you enter the market here. Let's forget about this one. You did not hit this one. The way that price came to this point. And as price came to this point, you're expecting price to break above, and price not break above, you enter your sell. As you enter your sell, you're taking a high here as your stop loss. Brother, look at it. Price did not come close. In fact, your stop loss is like an ajabo. Nothing happens to your stop loss. It's not under threat. Market sold and sold and sold and sold. Imagine if you were in Brent, even if it's $50 and you catch this market here, $50, brother. By the end of that $50, by the end of this market, that's if you will stay, by the end of this market, you collect your profits. Brother, you go price a new car and look for a new car. If you can stay, if you can be patient to stay and watch these things. Your own is that let price break above this moving average. If it immediately breaks above this moving average, I will leave the market. But as price did not break above the moving average, you are still a seller, until when price, look at it here, until when price came and break above the moving average. Even when it break above the moving average, did you observe that moving average 20 did not close? Look at this current price now. It has broken below the 2 moving averages. But moving average is telling you that it has not given me a signal for a sell, because this price can come up here and continue the buy. So it's telling you for moving average crossover, it has not given you a signal for a sell. But we know that price action, the market has given us a signal for a sell. Even at this point, you will see something like, well, that's what made me enter this market. You will see something like a head and shoulder. You see something like a head and shoulder here, a head and shoulder. We'll not talk head and shoulder, don't worry. But I just want to tell you something, a head and shoulder, which gives us a signal for a sell. And I keep telling you, I keep saying it, that this market, this Brent is coming here. Brent is coming here. Brent is coming here. But I will be very glad if this market will come up by the morning. Immediately I wake up and see Brent here. Only God knows. I will engage that sell and I will sell it to this point. Nothing will make me not to sell it to this point. And as you sell it to this point, this 20 period would have crossed 50 period. It will give you a confirmation for a sell. Then you wait for a pullback to that place and you continue your sell. If Brent will continue the sell. But if not, take something. So we're expecting first a sell to this point. That's what I'm expecting. A sell to this point. And after that, then we know what to do. Okay, I think that's moving average. That's moving average. I said this class was end for 10 o'clock. So I'll give you a moving average strategy. moving average strategy. This is moving average crossover. I have another one I use in trading. Look at this. I use this in trading too. This one does not cross. This one is like railway. It does not cross. This moving average does not cross. I don't want to remove it. Yeah, it's still there on my Bitcoin. It's still there on Bitcoin. Look at this moving average. It means two. I want to see the one that is very clear. I want to see the one that is clear. This is the one that is clear, devoid of. Okay, now look at it. This one has so many things. Using money trade. Okay. Okay, let me remove this. Let me remove some of this so that you understand what I'm saying. Okay, now look at it here. This is two moving averages. This way I'll stop. This is two moving averages, 20 and 20. They are both 20 and 20, but one is high, another one is low. What it tells me is that if I am trading on this, the same strategy I gave you, if price breaks above this, what I'll be waiting is price to come to this line, to this moving average. Any of the moving average, is either this first one or the second one. Preferably, I will prefer the second one so that it will give me a lower price, a far lower price for a sell, for a buy. As this market is going up, I'll be doing what? As I enter the market here for a buy, I'm expecting the market to continue to rally on this moving average. Have you seen? Look at where it pretended as if it broke, which is a false broke. But ordinarily, if this is your strategy, you will exit the market here. Yes, for real. You will exit the market here. That means you've eaten from here. Okay, let's say this one now. I think almost took your profits, your stop loss. No, not your stop loss. Because if you enter here for a buy, for example, if you enter here for a buy, let's say here for a buy, right? Let me see. You get this thing correct when the line is very straight. You enter here for a buy. Now your stop loss will be somewhere here. At least even if you don't have much money, your stop loss will be somewhere here. I don't really know how much it is based on your account size, 0.01. You enter here for a sell. Now when you enter here, this is your stop loss. You see that this market, because if you put your stop loss, you don't need to bother your stop loss. Leave it. If market comes to take your stop loss, is what you're willing to lose. No problem. That's why we say do not overly expose your account. Don't expose your account. By the time you go to advance, we tell you don't risk more than 3% of your account size. By the time you have a $50 account and you're risking 3% of your $50. 3% of $50 is barely 3% of $50 is how much? 10% of $50 is $5. Abi? 10% of $50 is $5. And 50% of $5 is 2.5. Okay, so 2.5. So okay, like, let's say $50, you don't expose plus or minus $2. $2 from your account. $2. That means that's $2 you're going to use as a stop loss. So that means you look for a price that when it comes to the moving average, it will give you the next low will be like $2. The $2 will determine your stop loss you're going to use. That means use 0.01, then you do 0.01 is 20 pips. 20 pips for you to take your stop loss, which is $2. By the time you put that $2, then the market rally. Imagine the market did all of this, even till here. This market have still not taken, even let's say, even till this point, that it break below, market have still not taken at the stop. But trading with these strategies that if it breaks below, go out of the market, wait for another opportunity for price to come above the moving average. Then you continue your buy to be on the safe side. Look at it break below, you would have exited the market at this point where it break here and wait for another opportunity for it to climb. Once it closes above, look at this now. This is an opportunity. This is when this market was here, this is an opportunity to buy this market because it is just on top of the moving average. It came back to the moving average. So it's an opportunity for you to buy. This market will scale up. Now it will definitely in the future come back to this moving average as a pullback, which is a little bit higher. Then you get your buy again. So at this point, that is where this moving average teaches you where to buy and where to exit the market. Immediately break below if you're buying, exit the market. If you're selling, it breaks above, exit the market, and wait for opportunity for the price to come back again for you to give, you buy or sell. Thank you very much, everyone. This is good. This is 10:11. So any question for me? Any question you want to ask? Please ask a question. Let's use the next 5-10 minutes to answer questions. Then we'll call it a day. Please ask if you have any question. Let me give it to some persons. Please, anybody that raised their hand, well, let's be civil. If you raise your hand, I'll give you opportunity to talk. I want like 3 persons to raise their hands and ask questions. Or if you don't have any question, you mustn't raise your hand. If you understood everything, then you don't need to raise your hand. All right, let's go. Who are those that want to ask questions? Question. In the next 1 minute, if I don't see any hand, then it is believed that all that was discussed was very clear and understandable. This is 10:12, so by 10:13, then we'll know that everybody understood all that was discussed. I don't see any hand. All right, Mr. David raised his hand. Who else? Is it only Mr. David? We're going to give opportunity to ask question. Who else? Okay, Mr. David, please shoot. Mr. David, ask a question. Unmute yourself, please.
Okay, sir. So you're talking about using the cross pattern to trade.
Yes.
Yeah. So my question is this: when you are using the pattern, is it that you are supposed to buy when the smaller moving average crosses the bigger one, or say I got somehow confused at that point?
Okay, let me share the chart again so I'll explain it.
Okay.
Okay, if you're using the cross, for example, like you were asking, if we're using the cross with the price, okay. If we're using the cross, okay. If we're using the cross, look at where. Look at the smaller period moving average, cross the bigger moving average from below. It crossed it. So now, yeah, it crossed it. The direction it crossed it is where you're going to trade, which is a buy. You see that the market was buying for this thing to have crossed, the smaller period moving average to have crossed. As it crossed it from below to above, it means a buy bias, a buy bias. Now, look at where it crossed it from. Look at where it crossed it from below. Sorry, from above to below. At this point, look at where it crossed it from below. Here, it crossed it from here. Look at it, 20 period it crossed. Why did it cross? Because the market is selling. Because the market is selling. So it tells you now that, guy, look for opportunity to sell this market and not spend your money or energy buying the market. Because at this point, the market is bearish. So when it crosses from above, that's the signal. Once it crosses from above, it crosses the high period moving average from above, is a sell signal. Once it crosses it from below, look at it. I give you this example. Once it crosses it from below, it's a buy signal. It's a buy signal. It's a buy signal. So you're looking at buying this market. So now that this market has broken above, you need to stay action. Wait if this one will cross. If it crosses, then you can engage your sell and engage your sell very well. I hope that's clear and understandable, Mr. David.
Yes, sir. Yes, sir. Thank you so much, sir.
All right, welcome. All right, I think every other person understood all that was discussed. So we're going to call this class closed. We'll be meeting again, hopefully, I don't know, I think tomorrow. So tomorrow is Friday. Let me see. We'll be meeting tomorrow, hopefully. Tomorrow, I'll send the link. I'll communicate with you. Meeting tomorrow. I don't like class on Fridays, but the weekend starts off on Thursday. So I think Okay, let me see. Tomorrow we will try tomorrow. Then after tomorrow, we can see how we can be doing it on Monday, on Wednesday, and Thursday. I think Monday, Wednesday, and Thursday will be better for me. Monday, Wednesday, and Thursday. All right, thank you very much. Those of us that made it to the class today, thank you. So and go to the comment box of the WhatsApp group and drop your comment on how you enjoyed this class. But please and please, I want to encourage you, always practice these things. Watch these things that we have taught. Watch it very well. When you watch it, you have a better understanding of it and you have a better way of trading it profitably. All right, thank you very much, everyone. Until then, see you tomorrow, hopefully, God willing. Until then, please do have a wonderful day. Have a good night rest for all of us at UTB Trading Academy in partnership with FSPs. Thank you and have a good night.
Thank you, sir.
Thank
Have a good night.
Thank you, sir.
You're welcome.